Ladies and gentlemen, Jason Gentile.
Thanks, sir. Appreciate it. We have to get Derek a higher microphone next time. Where is the clicker? Did Tom take the clicker with him? No. Is this it? All right, thank you, sir. I got to go through your disclosures. You're costing me time. I'm going to put this little quiz up to get us going here to start, so I'll click through and we'll revisit it here in a few minutes. But thank you. This is my favorite event of the year. I love coming out here and seeing so many people eager to learn about finance, economics, taxes. So I appreciate you at least attempting to stay awake through this entire presentation. My firm, I'm a financial planner, love doing financial plans. My firm does thousands of financial plans every year. In the area we spend the most time engaged with clients today, in financial plans, conversations, questions that are asked, it's primarily in the area of tax. And that's interesting because that's evolved over time, but now it really kind of dominates our conversations. There's a lot of reasons for that. Most of us probably had no formal education in the area of tax, right? We start kind of kindergarten through 8th grade, high school, college. We don't really ever learn about this. A lot of it is jargon. It feels like an unfamiliar language. And that's a real struggle for us, right? Most people who do maybe their own taxes using something like TurboTax, maybe understand it a little bit, some of the jargon. But I know myself, when I was first starting to get my taxes done, you just kind of trust the CPA. They give it to you, look at it, go, I owe money, or cool, I'm getting money. But we don't really dig into it that much. So it's a very confusing area. And it's not just Apella clients that really want to engage in this way. It's across our entire industry. There's a firm called Cerulli, and they do an investor survey every single year to find out what do clients want, what do end investors want, and what do advisors provide. What we find year over year in these studies is that the second most impactful thing that people want to spend time on is estate, and the number one thing is tax. So it's not just us, it's everybody. And when we start thinking about this too, there's other studies out there that are pretty interesting. There's two, one by Morningstar, which has been brought up a couple of times already today, and one by Vanguard. The Morningstar study that I'll reference is Minding the Gap, and I would encourage you to look that up. And the other one is the Advisor Alpha study done by Vanguard every single year. The reason I bring up the Minding the Gap one is because it has some overlap with what the Vanguard study is. And what Morningstar wanted to identify was what's the return investors get versus the actual products they own. Because they thought there was a big underperformance there, right? Sometimes we have bad behavior as investors, right? We're worried about elections, tariffs, the market being at highs every single day, right? Sometimes we do dumb things with our money. We get out of the investments at the wrong time. What Morningstar found was that investors underperform the investments by about 15%. I think the average, in 2023, I think the average return investors got was 6.3%. And somewhere around 7.4% for the investments in which they held. Vanguard was interested in this as well because they're kind of the king of the do-it-yourselfer. So they were wondering, okay, well, if our investors are doing worse than our investment products, how do we help them out? And what they found was that advisors actually add a lot of value to the end return of an investor. And in this Advisor Alpha study, they found that advisors can add about 3% to a client's rate of return. A lot of that is in that behavioral aspect. They kind of estimate about 1.5% in that behavioral coaching arena, right? Keeping you in your seat during these difficult moments. But the rest of it really all centers around tax, picking tax-efficient investments, making sure they're located in the correct types of accounts, distribution strategies, gifting strategies, RMD planning, cash flow management. So, the reason I point that out is because this is an extraordinarily difficult area. There's a lot of complexities to it, and it's okay to ask for help. And around all of these walls and kind of out there, there's lots of Apella advisors that can help answer these questions for you. So let's dig in. When we do a financial plan for any client, we gather a lot of information. We gather all of your financial statements. We gather your liabilities, mortgage, et cetera. We do cash flow planning. We get your estate plan. But we also get your tax return, and we really dive into it because we want to understand it. Most tax returns have somewhere between 10 and 30 planning opportunities or points that we look for, depending on the complexity of the return. But we also want you to understand it. And this is a smushed, technical term, down version of what that report looks like. Right? We want you to understand your filing status, what marginal rate you're in. Are you itemizing? What's your effective or average tax rate? How much room do we have left in those buckets? How close are we to falling into that next IRMAA bracket for Medicare, capital gains? How close are we to phasing out of certain tax opportunities? So what we're hoping here is that we learn something and that you learn something. We're going to focus primarily today on federal because there's a lot of nuance in the different states, right? And I don't know where everybody's from. So we're just really going to focus on the federal aspects of this today. But I would tell you there's a lot of complexities that are layered on when you start talking about state income tax as well. But just keep the mindset that we're focusing primarily on federal today. So as you transition from your work life into retirement, we've saved, we've spent, we've worked 40 years. And all of a sudden we hang up the work boots and we have to figure out how to get our own insurance, Medicare. Most people don't think about Medicare or Social Security until the day they retire, right? Or slightly before that, hopefully. These systems have been around for 100 years, but we don't really understand them until we absolutely have to. Gone for most people are things like child credits, mortgage interest, et cetera. So maybe we've moved from itemization to standard deductions. We have to start to figure out how to take money out of our 401ks instead of putting money into them. So it's an entirely new world. And I saw a raise of hands here on your ages. So a lot of you are in that baby boomer generation and this great thought experiment that we had regarding the 401k, right? Trying to get people to save more for their own retirement. When it was implemented in the 1970s, it didn't come with a user manual. We didn't know how it was going to work. We didn't know how people would invest. But for 10, 20, 30 years, people socked away money via their payroll deductions. It grew, it compounded, they invested, it grew more and more and more. We didn't really think about at that time, how are we going to get money out of this, right? So this is a great tool because it's really the only tool we have. But now all of you, if I had to wager a guess, most of your wealth is tied up inside of retirement accounts. And when we think about that, you're really in a revenue sharing program with the federal government at that point. So you might have $500,000 in your account, but I got bad news. It's not all yours. So we need to figure out how to actually effectively take that money out. And kind of part of the problem, too, is for decades, maybe the past 100 years, probably you have heard this from your parents, your grandparents, maybe even your CPAs over the years, especially the ones that have very, very gray hair. Don't pay $1 more in tax than you absolutely have to, right? And that's counterintuitive to a lot of the things we're going to talk about today. What we're trying to do inside of your financial plan is make sure you pay less tax over the course of your lifetime and make sure there's more wealth transferred to the next generation of the causes that you care about. I think it's January 31st in the Wall Street Journal. There's an article actually that speaks directly to that. It's something along the lines of when paying more today makes sense, right? And once again, it's very counterintuitive to a lot of what you were raised on. So I'm going to circle back to Social Security and Medicare. There's a whole Medicare presentation today, which is going to be extremely informative, so I'm not going to spend a ton of time on that, but there's a few things in the world of tax I want to make you aware of. So we'll start with Social Security. And this is the quiz that started at the beginning. So with Bill, all he wanted to do is go see the Grateful Dead, needed $1,000 to do it, no big deal. This guy worked his whole life, spent $1,000 without thinking about it, so what's the big deal in doing it now? Well, it's interesting because that $1,000 for a person who earned this amount of money in taxable income, he looks at his tax bracket and he says, well, I'm in the 22% tax bracket, this $1,000 will cost me a couple $100, no big deal. But what he finds is it kind of was a big deal. And granted, these aren't large sums of money, but these are the trickle-through impacts of decisions that we are not aware of. So for a lot of people, what happens is, who are low earners or don't have a lot of assets, some people actually have Social Security that isn't taxed at all. But some people might have up to 85% of their Social Security benefit taxed. And that's what happened to him. This $1,000 pushed more of his Social Security into being taxable. So the reality was, even though he sat squarely in that 22%-ish tax bracket, more of his Social Security became taxed, and he actually owed $400 and change on that $1,000 distribution. So this is, like I said, this is a kind of simple example of impacts that we don't really think about when we're making a decision, especially early on in retirement. Because most of you haven't really had to think about spending money like that when you're working, right? It's not something you lose sleep over, $1,000. But in this case, imagine what could have happened if the amounts were bigger. In the world of Medicare, and like I said, there's a Medicare presentation today, so this is not a Medicare presentation. But we're going to change the example a little bit. We've got some very high earners here. You can see George and Martha. They earn $334,000 in modified adjusted gross income. And we're going to focus on Part B and Part D premiums. Everybody familiar with IRMAA charges, income-related monthly adjustment amounts? Here's the challenge, right? If you go back to that smushed down version of the tax report that I showed you at the beginning, there's not really alignment between the tax rates and the IRMAA rates, right? So people don't understand that even if they're staying in the same tax bracket, it actually might have impacts on their Medicare. So for them, they hold this stock, and the stock's just been taking up space. It hasn't done anything. It's just been sitting there. They got a $1,000 gain in it, and they say, screw it. I'm getting rid of this stock. We're going to redeploy the cash into something else. They take that $1,000 in capital gain form, thinking that, hey, we're high earners, so we have to pay 15% on capital gains, but we also have to pay that 3.8% net investment tax because we earn more than $250,000. No big deal. $1,000 gain, $200 tax bill, we're okay. But what happens is one more dollar of income in the Medicare IRMAA brackets, they tip completely into that next threshold. So instead of paying $370 each in terms of a Medicare Part B premium, they now move into that $480. And it's not just for one of them. Even if it was an individual brokerage account, it's happening to both of them. They're married, filing jointly. So their Part B premiums go up $220 per month. Their Part D premiums also go up. And for each of them, it's about a $20 increase or $40 a month. So they sold a stock for $1,000 thinking they'd owe $188, but what happened was they owed $3,182 plus $188. So that turned into really a real rate of 337% on that one distribution. I can imagine that most of you at some point or in your own portfolios have looked and just said, I'm sick of looking at this stock. I'm going to get rid of it. Well, here's where advice is absolutely needed because, once again, it's not progressive like our tax rates. These are cliffs, right? So one extra dollar, not just, this was an example of 1,000, one extra dollar pushes you into that cliff. So wide-ranging ramifications, obviously, in terms of Medicare. And we don't think about that as a tax, but ultimately, the capital gain leads to these charges. I'm going to skip these and go into this. So really, the big kind of complexity in retirement, and Tom touched on it a little bit. If we know we can spend up to 4% in our portfolios, where do we take it from? It's pretty easy if maybe we only have an IRA. But what if we've got a brokerage account, a couple IRAs, a SEP IRA, a Roth IRA? How do we manage the distribution? Once again, just like your accountant telling you don't pay $1 more in taxes than you absolutely have to, old rules of thumb that say take from your taxable account, then your IRA, then your Roth. Well, it doesn't really apply, right? There's no rules of thumb in this. And quite honestly, they may apply to you, but they may not apply to you. And I would tell you that even if that methodology did work for you this year, it'll probably be different next year. Distribution planning is maybe the most complex area of financial planning to make sure that we're taking from the correct place to mitigate taxes over time, but also to preserve wealth for the things that we care about beyond our own life expectancies. Most of us want our kids to inherit something. We care about legacy planning. You know, one of the ways that we do this planning is Roth conversions. And I'm sure most of you have at least heard the term, if not done them yourselves. But realistically, a Roth conversion is simply taking money that's in an IRA today, paying tax on it, and moving it over to a Roth IRA. And that Roth IRA will grow tax-free and will be distributed tax-free if certain rules are met. We utilize a technique called filling up the tax bracket. And shown on here is kind of a silly way of doing it, but filling up these different buckets. Right, so in this example, this person has completely filled up the 10% bracket. They've completely filled up the 12% bracket, but you can see they're about halfway done filling up that 22% tax bracket. So in cases like this, we would suggest to them, hey, let's take a little bit more money from your IRA, convert it to a Roth IRA, fill up that 22% tax bracket. That preserves future, or that decreases future required minimum distributions, moves more into a tax-free bucket. And quite honestly, even if that isn't super impactful to your distribution strategy, it's a great estate planning tool. So we implement it for a lot of different reasons. What you're looking at here is straight out of our financial planning software. And this is a lot to digest, so I'll take you through this as quickly as I can. But in this example, what we're looking at here is somebody who doesn't have a lot of money in taxable accounts. They retired with a few $1 million inside of IRAs, very low income earners. Each one of these bars represents the total tax due in a calendar year. You can see the calendar years listed on the bottom of that chart. The example here of taking money from your IRA and converting it to a Roth is represented by red, right? So red is we are paying more taxes in those years. The gray represents the reduction of tax in future years as a result of paying more tax today. And you can see this in this example. This is a pretty extreme one, but it is pretty close to a case that we did. This shows that $800,000+ are saved in total lifetime taxes by doing this. And I think if you look at that chart, you'd go, well, there's no way that you did $800,000 worth of distributions. And we didn't. It's very small distribution amounts, but what happens is that money is moved out of the IRA. The future growth of that is moved out of the IRA. It's moved into a tax-free bucket, but your required minimum distributions are now much less. And what we find, basically because of how folks have saved over the last 10, 20, 30 years, primarily in their 401ks, a lot of people end up in as high, if not higher, tax bracket because of required minimum distributions and the forcing out of money from your retirement accounts, even if you don't need it. We look at it a different way, where we layer on the tax rates. And you can kind of see that orange one that we fill up there is the 22% tax bracket. And the orange bars are representative of the taxable portion of the IRAs. What we're trying to do, and you could make a case for even going higher, because between the 22 and the 24% tax bracket, not a lot of room. And there's a lot before you get to that 32% tax bracket. Interesting in here, though, if you look at kind of 2043-ish on the chart, all of a sudden their income is now so high in retirement, north of $250,000, that now the net investment tax, that 3.8% capital gains tax add-on is going to impact them as well. So there's a lot of things that we're trying to do here. Additionally, where that triangle shows, we have men live to 90 and females live to 95 in our financial plans. That's first death. And what you can see there, and as you probably know, if you, as a spouse, inherit you assume your other person's IRA as your own, you're taking required minimum distributions now as a spouse based on your own age. But at the end of the day, this person, even though they're single, tax brackets are compressed, they're still in a very high tax bracket. That's what we call the widow's penalty. So what we're really trying to do is mitigate these tax impacts for joint, single life, inheritors, but we can do a lot of tax planning that saves real money. And that goes back to that Advisor Alpha study from Vanguard, right? This is real impactful change. There's other ways to manage this too. We don't do a lot of insurance policy withdrawals except in extreme circumstances, loans, et cetera, things like that. Selling highly appreciated stock, if you're in a low enough tax bracket, you might pay 0 on capital gains. We look at tax loss harvesting as advisors. Pretty much every month we're looking at it. I think most end investors or do-it-yourselfers probably don't think about it until December, but we're constantly looking at this as opportunities to harvest gains and offset them with losses throughout the portfolio. Been hard to find losses the past few years, but they're out there. And I mentioned Roth conversions, but maybe there's no reason for you to do a Roth conversion, but maybe you need a new car next year, or maybe you need a new roof in a couple of years. So we're going to fill up the tax bracket by just taking additional distributions. Why waste that opportunity of not filling up that bracket, knowing you're going to need the money in potentially 1 to 2 years anyway? So there's a lot of things that we're doing around cash flow management based on projected goals and needs. I'm going to skip that one too. We are very fortunate to work with so many charitable folks. Our clients are incredibly generous, and we do lots of donor-advised funds, stock gifting, qualified charitable distributions. In this example, and this probably will happen to a lot of folks here, Albert and Shirley live in the 24% tax bracket. That's just who they are. And they want to give $5,000 to charity, but all of a sudden they don't have mortgage interest, they don't have a lot of these other things to help them itemize, and the standard deduction is pretty darn high now, right? So if they just gave $5,000, they're really not getting any federal tax benefit. So what are the things that we can do around that? If you're unfamiliar with qualified charitable distributions, remember, RMD age is now 73 and 75, but they didn't change this rule. You can still do QCDs, charitable distributions, direct from your IRA at 70 and a half. It's got to go directly to the charity. So our clients reach out to us with lists of all the charities they care about. We prepare the forms. We give the money directly from their IRAs to the charity. Never touches their hands. You don't get a deduction on your income tax because you're not paying the tax on the income. So let's look at an example again for, I think it was Albert and Shirley. If they took the $5,000 directly from their IRA, 24% tax bracket, they're going to pay the tax on that and then give money to charity, right? It's kind of wasteful. If we did it as a QCD, direct from the IRA into the person's desired charity without it touching their hands, it's excluded from taxable income. It goes direct to the charity. Charity gets all of it, and you avoid the tax. Satisfies your required minimum distribution. As a caveat, though, I will tell you that important to note that places like Schwab and Fidelity, on your 1099-Rs that you get from your custodians, they're probably not going to show you that you did a QCD. They're just showing that money came out of the IRA. So you really, if you're not working with somebody like us, you really need to make sure that you identify to your tax preparer that, yes, you did a distribution, but it was a qualified charitable distribution. Otherwise, you're going to end up paying tax on that distribution. This is a big one, too, and this is tax between generations. And like I said, our clients are incredibly generous with charities, church, alma maters. But we also want to make sure that we leave something behind to our children, our kids, grandkids. We care about that aspect of it. And having a true legacy plan and understanding who gets what is incredibly powerful, right? So who gets what really matters if you want to preserve more wealth to the causes and people that you care about. If I died tomorrow, my kids inherit my life insurance as beneficiaries. They pay no tax on that benefit. If I die tomorrow and have a brokerage account, my basis is no longer what I paid for it. My basis cost is stepped up to the value today. And if they were to sell it relatively soon, they'd probably pay little to no tax on that as well. If I died tomorrow, my kids inherited my Roth IRA, they'd pay no tax on that distribution. They'd have to withdraw the money within 10 years, but it's all tax-free. If I died tomorrow, my kid, and I have $1 million IRA, each of my kids inherits $500,000. Well, now they need to take those distributions within a 10-year time period. $500,000. Doesn't matter how, just got to all be gone in 10 years. Right? So they can take a little bit every year, they can take it all at once. But what happens if I sit in that 22% tax bracket and my kids are doing great? What if my child who is inheriting my IRA is in the 37% tax bracket? I kick the bucket, and all of a sudden it goes from 22 to 37 upon those distribution years. So understanding who gets what really matters. So when we're doing estate and tax and distribution planning, we want to make sure if there's a charity involved, give them the most tax inefficient thing. Preserve more wealth inside of your family. You know, around things like long-term care, I don't want to spend a ton of time on this, but I know this is a common question we get from a lot of folks. There's a lot of different ways to buy long-term care. You can buy a traditional policy. You can buy paid-up policies, and you can get these policies that are hybrid, tied to a life insurance policy. There's a lot of different aspects that are pretty confusing. We'd probably do an entire hour on this as well, but your premiums may be deductible. Benefits for reimbursement are tax-free. How you use these is really impactful to your heirs, though. And I'm just going to focus on one example of it, where we have a life insurance policy with long-term care benefits tied to it, right? So a hybrid policy. And an example of this might be if I have a death benefit of $500,000 and I use some of that benefit for long-term care needs, my death benefit is reduced. So in this example, Florence needs some long-term care. And pretty low tax bracket, right? But she's got kids and she wants her kids to inherit some money. And how should we do that? Right? Remember, life insurance as a death benefit is tax-free to the child. In an IRA, they have to pay tax on. So we have to really think about this. And kind of logically, you'd say, well, I've been paying for these LTC benefits the whole time. Like, why would I not utilize them? So let's look at this kind of simple case here. So her expenses go up because she needs long-term care. And if she uses her IRA money to offset that, all of a sudden her kids now will get more of the death benefit and less of the IRA. And that's super impactful, right? That 10-year distribution rule at $500,000 versus $100,000 is great. Tax-free benefits, far more efficient. You know, one thing I should mention too, because I think it does matter to a lot of folks in this room, I was talking about if I die, who gets what? I also have the question or conversation of how are my kids doing? I gave an example of me dying in a 22% tax bracket and one of my kids being in a 37% tax bracket. What if my other kid's in a 15% tax bracket? Is there an equitable distribution of wealth there if they're both getting $500,000? Let's say the kid who makes less or is in a lower tax bracket actually makes out better in that scenario. So that's another incredibly important thing when you're doing your legacy planning and your tax planning over the course of your lifetime to really consider. Who gets what? And it's something you're going to need to revisit multiple times, right? This is not set it and forget it. Your taxes, we're trying to mitigate them over the life of your plan, but realistically, we're trying to mitigate them over the life of your kids and anybody else who might be fortunate enough to inherit some assets from you. So, you know, there's a lot of different phases of your retirement life, right? Pre-retirement and early retirement. We have this important window, this opportunity between the time you retire, let's just say 67, and 75. This is our biggest opportunity to make drastic changes to the taxation of your future benefit and how your kids inherit money. This is an opportunity that we can't waste because time, as you know, is invaluable, especially the later in life that you get. I would also say, too, that you really need to understand the overall impact of your decisions. Like we looked at with Social Security, like we looked at with Medicare, like we looked at with just capital gains, et cetera. Small decisions that you have thought about, not even for a millisecond previously in your life, those decisions have ripple through effects now. So mistakes can be costly, and I would encourage anybody who has real questions about what the future reduction we can help with in terms of taxes during your lifetime, future years, how to improve your estate plan. Find somebody out there that's got an Apella name tag on, ask for help because it is really impactful, it's eye-opening, and ultimately, like I said, you do not want to waste this opportunity. So there's no time for questions because I already got the finger. So I'll just say thank you and move on. I appreciate it. I look forward to seeing you next year.